Welcome back to Real Estate Radio TV, the commercial real estate focused media. In today's interview, we have the great honor to welcome Manuel De Lacalle, Associate Director at AZORA. AZORA being one of the largest independent asset manager based in Spain, investing across various sectors such as hospitality real estate. In today's interview, we are going to discuss many different topics, including insight on the current state of the hospitality sector in the Iberian Peninsula, its overall resilience, if new deals are coming to market at attractive price in today's environment, where can we expect the Iberian hospitality sector to be headed in the upcoming 5 to 10 years. Manuel, how are you today?
Great, Dr. Thank you very much. Very excited to be here, sharing with you this opportunity. And I think this is a great initiative that you've put together for people from the industry to learn from each other, to discuss new ideas with each other, and to get exposure to other people's ideas. So thank you very much.
That's the goal, and thank you for being a guest today. So before we dive in and talk all about the great topics we've planned for today's interview, I want you to give us a brief introduction of yourself and also Azora really establishing itself as a leader in the hospitality real estate space. Kind of walk us through your investment mandate and what your investment looks like at this stage of the cycle.
Sure. So starting with myself, I studied law and business in Madrid, and then I moved to London. I worked as an investment banker at Rothschild for a few years. Following my time there, I moved to GHO Capital, which is one of the leading pharma-focused private equity players in Europe. And from there in 2018, I moved to Azora to join the hospitality team and help it raise the fund which we're currently investing now. In terms of Azora, we were founded in 2003 with a focus on residential, and from there we've grown into one of the largest real estate independent platforms in Spain, managing over 9 billion assets under management. So we have, as you mentioned, various verticals. We do residential, offices, logistics, elderly care, and of course hospitality. So in the hospitality space, I would say we are one of the largest hospitality investors in Europe, having deployed over 3 billion and acquired over 100 hotels in the last 10 years, 100 hotels and over 20,000 keys. In terms of timeline, hospitality timeline, we raised our initial fund in 2011 to invest in urban leisure. In 2014, we raised Hispania, which was a very large REIT with very well-known investors, which in 2018 was already the largest sun and beach hotel owner in Spain with over 40 hotels and 10,000 keys. That was sold to Blackstone in 2019. And from there, we launched the fund which we're currently investing from. And with this new fund, we've invested over 1.4 billion in the last 4 years in 42 hotels and 12,000 keys spread throughout Spain, Portugal, Italy, Greece, and Germany.
The hospitality sector is really an industry where we've seen a lot of challenges over the past couple of years. We've seen the pandemic shutting down tourism. We've seen inflation, as we all know. Hospitality is really a capital and labor intensive type of investment. So really, based on today's cycle, what insight can you give us on today's hospitality market, at least for the Iberian sector?
Yeah. You mean from an investor perspective?
From an investor perspective, as well as the current macro perspective overview of the sector.
Yeah. I mean, I think from a macro perspective, we are very bullish on the market. So if you take a step back in 2019, there were 1.5 billion arrivals worldwide in terms of tourists, and that is expected to recover in 2024. However, if you look at the numbers in more depth, you will see that there are certain geographies and segments which are going to recover much faster or have been already recovered 2019. And certainly the leisure hospitality tourism in the Iberian Peninsula is one of them. And there are three main drivers for this. One is proximity tourism. So if you look at the data, proximity tourism had already recovered 90% of 2019 levels last year, and is expected to reach uh, in 2023 the 2019 levels, whereas international tourism is still around 10 percentage points away from 2019. The second is that Spain is a mainly leisure destination, and leisure spend worldwide has already recovered this year 2019 levels, or around 9.9 trillion spending. And finally, Spain is located in the Mediterranean, which is the absolute winner in terms of sun and beach. And so if you look at the recovery of tourism in Europe, you will see that the main drivers are the Mediterranean countries, especially Spain, Portugal, Italy, and Greece. So, the good thing about Spain is it's part of the most well-known resident touristic destination in the world, which is the Mediterranean, and has a very strong leisure focus and is very accessible by proximity tourism. All these mega trends have uh, have made the recovery much faster than worldwide tourism.
And in terms of the impact of inflation on hospitality, and really, has hospitality been an edge against inflation with the growth of ADR that you've seen on your properties? I mean, what's your take on that?
Yeah, I think I mean that's clearly one of the biggest questions and one of the main fears investors have today, clearly in hospitality and in all the real estate sector. And so far the results have been very positive. So we ran an analysis on basically, on our portfolio of the 40 hotels we have, we chose the ones which hadn't been refurbished during these past 2 years, and we compared ADR and RevPAR levels from 2022 compared to 2019. And not only has there been a very strong increase in ADR of between 20 and 30%, but there's also been a very strong increase in RevPAR of between 15 and 25%, and that would compare to a 12% increase in inflation over the same period. And so, that's a very positive outcome. And it's also interesting to bear in mind that our portfolio is not only a luxury portfolio or located in certain specific areas. It is a very broad portfolio spread over many countries, and we cover, from mid-scale to luxury, and in general, all of them have performed above inflation. So I think the general trend is very positive. And for
So,
2023, we're also seeing, in terms of rooms and books, very positive numbers. So we think this will continue going forward.
so strong fundamentals in terms of rental growth, also occupancy, really from an investment perspective is what we're thriving for, correct?
Yeah, exactly. I mean, I think at the end of the day, the the strength of the hospitality market comes from the fact that even though it's discretionary spending, it's not first necessity spending like, the residential market. It has become a top priority for many people around the world. So and that makes it much more resilient, and that makes people much more they prioritize spending in travel versus other types of spending, and that makes it more resilient and easier to navigate the downturns.
Hospitality is a very wide industry and encompassing a lot of subsectors, starting from economy and style hotels up to 6, 7 star hotel. You've also mentioned leisure hospitality. So really, based on your experience, what sectors within hospitality has shown to be the most resilient over the past couple of years and really continue to show the strong and going fundamentals?
I mean, clearly, it has been the leisure industry that has been much more resilient than the business one. And I think, well, if you look at the past three crises, apart from the COVID one, if you look at the dot-com bubble, 9/11, the global financial crisis, and obviously, of course, COVID, in all of those four cases, leisure tourism recovered much faster than business tourism. And the ADRs increased at a higher percentage than the inflation rate. And in this particular crisis, the main winners inside the leisure segment, I would say, have been proximity tourism destinations, as we discussed earlier, and also I would say horizontally built resorts. People have really, uh, you know, paid a premium and priced being able to have their space. So these emerging horizontally built resorts, family villages, glampings, camps, and so forth, have been extremely popular with clients.
So when you mean horizontal leisure tourism, you mean like full inclusive type of hospitality where people can get various services? Is that correct?
Yeah, I mean, if you think about the hospitality industry, the typical sun and beach hotel has always been the vertically built hotel, surrounded by similar vertically built hotels, anchored around the beach or a town or whatever. And although even though these hotels had different offerings and brands and so forth, the layout, the amenities offered were generally very similar. And what we've seen over the last 3, 4 years emerge are uh, these new segments, which are much more which are different to what the typical hotel has always been. So, imagine 10, 15 hectare big resort spread horizontally with bungalows made of wood. People, felt much more comfortable to be able to go there instead to a horizontal built hotel. They had more space, they were in contact with nature, away from technology. So that kind of concept it has crystallized now, and we think in addition to other concepts such as the experience tourism, people are much more willing to spend on experiences, be they musical experiences, entertainment experiences, sport experiences. Then you've got the wellness and active sports trend. People are looking to spend more time looking after their mental and physical health. So all these new trends are creating a new asset classes, which, in addition to the typical horizontal, vertically built traditional hotel, are going to drive the growth in the future.
And in terms of the segment, have you seen a bigger momentum, a bigger resilience for luxury style hotels? I mean, we've seen luxury brands doing record profit or more resilience toward economy style hotel. I mean, what's your take on it?
Yeah, I mean, clearly luxury has been one of the biggest winners in the last 3 years, with extremely high ADR increases versus 2019, and also keeping very good occupancy levels. I think that, people after COVID, there were a couple of reasons. There were a lot of pent-up savings. People were very looking forward to experiences and to being able to enjoy life. And also many people made a lot of money over the last decade. So luxury tourism has clearly been one of the big winners. I think, a word of caution in terms of the luxury industry is that it has a very high operating leverage. So if you have good occupancies and you can charge high rates, then you can make a lot of money there. But if at some point rates have to decrease or occupancy decreases, the structure you need to run the hotel is the same. So relatively quickly you can run into problems, which doesn't happen in the lower, mid-scale budget, which is much easier to adapt. And also there is a large supply of luxury hotels coming to the market in the following years, so we'll have to see how the supply and the demand interact.
That's where I wanted to go. So, do you see a lot of new supply coming to market across various segments? You've talked about the growth of horizontal style hotels. I mean, do you see new supply coming to market?
Yeah, I mean the good thing about the hospitality industry as well is that even though demand increases typically around, at least in the last 10 to 15 years, 4 or 5% per annum, supply is relatively capped. Not because people don't want to construct more, but because of regulatory restrictions. However, there are being many, especially in urban environments, many changes of use to hospitality, especially in the city centers where you can build powerful luxury hotels. And also, there are many funds like us that focus on repositioning existing hotels into more upper scale segments. So I think it's not, it's all, it is new supply, but not, but mostly coming from either changes of uses or existing properties which are being redeveloped and repositioned.
All right, so no, not really any new major new development taking place, at least on a large scale.
Not on a large scale. They are, of course, but it's and that's one of the things about Sun and Beach. When people think it's more the perception is that it's a more it's less safe than investing in urban. But if you think about it, being able to find the licenses to develop in first line beachfront anywhere is extremely difficult. So actually, the beachfront supply is much more limited than the supply in city centers.
And talking about the regions, I know pre-interview we discussed a little bit about Malaga. Really, what are the regions where you've seen the most growth? Because from my understanding, Azora is really investing across various regions in Spain, but also in Portugal. So really, what region have you seen the strongest growth in terms of tourism, ADR, and occupancy ratio?
In I would say we've seen a lot of growth across the board. We've had a very strong performance with our assets in Algarve, which are five-star luxury assets, focused on international tourism. We've seen ADR increases of 30 to 50%. But we've also seen, for example, a lot of growth in Blue Serena, which is our Italian hospitality platform, which is the second largest sun and beach platform in Italy, focused exclusively on Italian domestic, middle class segment, and and it's worked extremely well as well. So I think in general, the industry, if you were positioned in the right segments which were, leisure, sun and beach, so forth, you've been able to get advantage of all the mega trends in the sector. I think where there have been more issues or where only selective properties have been able to grow is in the MICE and business segment.
Nice in business. And so, talking about the current investment opportunities, really in today's market, all we can hear about is the current capital markets that have created some real disparities between buyers' expectations, sellers' expectation. They have impacted valuation, at least in some part of Europe. So, really, based on your current deal flow and the deal flow that you've seen those past couple of months, are you still able to find and look for properties to invest in, or is the market in between two cycles?
Yeah, I think that at least in Europe, it's the market is a bit it's not very fast at the moment, and I think the reason is that, I mean, the situation now has changed a lot from last year. So, and there are three main topics which, in our investors' view, would warrant a lower price. One would obviously be the cost of debt, which has more than tripled from, March 2022 to now. So from an all-in cost of around 2%, now it's over 6%. So it obviously means that lower cash flow for the investor. Second is inflation, which although we are being able to push it into tariffs, it's not warranted that that could continue indefinitely in the future. And at the same time, you have a higher cost base because inflation is eating into your margins. So that would also potentially represent a lower cash flow for you as an investor for the foreseeable future. And the third point is cap rates. As you know, real estate assets are priced at a premium or discount, however you see it, to the 10-year bond yield. So uh, last year we had a 400 spread between the 10-year Spanish bond and the premium real estate hospitality investments in Madrid. Now that's down to 150, 200 basis points. But if you assume that yields are going to continue increasing, or at least you don't know what's going to happen, and that you have to maintain that spread, then it is a potential scenario in which in which cap rates increase, and that would obviously decrease the value of the asset. So those three elements, in our view, warrant discounts to current pricing. In addition to the fact that all this uncertainty around, energy, uh, Ukraine, inflation, potential recession, and so forth, you know, warrants, in our view, a small cushion in addition to these three elements we just discussed. And obviously, the sellers don't see it the same way. So as of today, as long as the sellers are able to refinance and as long as they are in a good financial position, I don't think there will be many transactions in the market.
Talking about refinance, I mean, a lot of debt will come to maturity this year, and some investors predict that we're going to see some distress opportunities coming into play that, will kind of pick up the transaction volume that we've seen over the past couple of years. Do you believe that's something that's going to happen based on your expertise, or the market will just stabilize over the long term?
Yeah, I think it should. I mean, but we also thought that would happen during COVID, and it didn't. But at that point there were many helps and government support to companies. But I think at some point that should happen. Whereas is it this year or next year or the following one? But at some point when these refinancings come, I mean, current owners will have an issue. I think that's also why you're seeing many credit funds raising money and credit funds from the US coming to Europe, because there's going to be a gap there. Because if valuations go down, the LTV is the same, then obviously you will need more financing to refinance your previous loan. So I think that's the opportunity that credit funds are seeing, and that's what they want to tap on in the next year, 2 years.
And we've really talked, a lot about those past couple of years. But now I kind of want to switch gears and talk about the future and really the macroeconomic perspective of the hospitality sector in the Iberian Peninsula. I mean, what are your predictions over the medium to long term, let's say 5 to 10 years, on where the market will head from a consumer perspective, from an investment perspective, to get a bit of a macro idea?
Yeah, I mean, I think it's we are very big believers in the market. From a supply and demand perspective, uh, we had 80 million tourists in 2019. That's expected to reach 120 million. That's for Spain only in the next decade. And at the same time, you've got a very constrained supply growth over the same amount of period. So that obviously is a good dynamic in terms of supply demand. And at the same time, you have an unparalleled offering in Spain and Portugal in terms of local cuisine, culture, social entertainment, still very safe countries. So, we think we will continue being the market leaders for this foreseeable future. In terms of investments, that will depend more on the topics we discussed previously as to what happens with the interest rates, what happens with inflation, what how current owners are able to refinance their properties, and whether, yeah, at some point we reach an agreement on what that discount should be. But in terms of the supply demand dynamics, we think it's great. And we also think that um, the good thing about Spain, and going back to again the previous topics, is that we're not only very strong on the traditional hospitality product, but we're also being pioneers in these new emerging trends we were discussing earlier in terms of, open air space, camp, glampings, holiday villages. There's being a lot of developments in that front. Uh, we're also very powerful in the experience-driven hospitality segment in terms of the music hotels in Ibiza. You've got a lot of wellness and sport resorts in Valencia and the Canary Islands. So I think we're still at the forefront of where we should be.
Spain and Portugal over the past 10 years, I would say, has attracted a lot of capital coming from Europe, but also the United States and other countries. Do you expect that we're going to see more capital, either through LPs or direct investors wanting to get involved into the Spanish and Portugal market over the next couple of years?
Yeah, absolutely. I think we are, the first market everybody thinks about when looking to invest in hospitality is Spain and Portugal, especially Spain because it's the most consolidated market in Europe, much more than the Italian or the Greek market. It's been on, with the Spanish market started developing in the 1970s. The Greek and Italian market have only started developing, a few years ago in terms of international tourists. So absolutely, I think that's one of the reasons why one of the additional why you won't see many discounts in Spain and Portugal is because there's being such an attractive sector and having so many funds now interested in investing in the space in Spain. You will have current owners will have much more options than if you are looking to invest in Italy or Greece, where you may find more opportunistic deals.
Manuel, thank you for coming to our show to discuss your knowledge and really hospitality as an investment sector in Spain. I'm sure we'll have the opportunity to conduct other interviews. Before we let you go, anything else you wish to mention that we maybe haven't touched on?
No, I think we've touched on everything. And thank you to Dual for the opportunity and hope we'll be in touch.
That's great. Guys, make sure you download our app. That's free and available on all social media platforms on the App Store and Android. We'll also put your contact information, such as your LinkedIn profile, in the bio. If people ever want to reach out, they're more welcome to do so. And until next time.
Okay, thank you.